Hello, welcome to the Bloomberg Intelligence U.S. Industrials Analyst Call. I'm your host, Christina Fury.
Hi, this is Mustafa Okur. I cover electrical and flow control equipment at BI.
And Chris Cellino, I cover U.S. machinery.
I'm Karen Ubelhart. I cover large cap industrials and the rental equipment sector.
Great. So we've had some exciting M&A happening in this space last week. So we're going to start with Chris today and discuss the AGCO deal to acquire Trimble's ag assets. What do you think about this deal?
It's a great deal for AGCO. You know, they acquired Trimble's ag assets and technologies. It was a little over a $2 billion deal through a joint venture structure. AGCO will retain about 85% of the JV, and think really it's a great fit for them at a very reasonable price. From a strategic perspective, it will increase their exposure to the highly profitable and rapidly growing precision ag market and really strengthen their portfolio, particularly around guidance, autonomy, precision spraying, connected farming, and data management. And the deal forms really a mixed fleet focused precision ag portfolio, which we think nicely complements AGCO's retrofit first approach to precision ag. So we think there's some market share opportunities in the near term as some of the adoption rates begin to pick up. And we believe the transaction will ultimately help narrow the margin gap with some of the larger peers, including Deere and CNH in the space over time. As it really kind of mix shifts them into a higher margin products. And they're also looking to get out of some lower growth underperforming assets, particularly the grain and storage business. So we think ultimately it helps mitigate some inherent cyclicality in the business today.
For the broader audience, could you explain what precision ag is, maybe what AGCO's been already doing, and then like how this is going to help them?
Sure. So, precision ag includes everything from guidance to targeted spraying and planting, essentially using more technology on the farm. This, ultimately helps increase yields. It could help reduce costs rather than, spraying fertilizer across the entire field. It would just target where it needs to be applied and at a particular time. That's just one use case, but it's broadly used from planting to harvesting and everywhere in between. AGCO's targeting about a combined more than $2 billion in precision ag revenue by 2028 with this deal. That's up from roughly 1.3 to 1.4 on a pro forma basis today, which we think is overly conservative. It really just implies a roughly an 8% CAGR, which isn't heroic by any stretch. Their core precision ag business prior to this deal being announced had been growing at a 25, 30% CAGR over the past 3 years. And there's a number of new product launches coming over the next 3 years. So we think it's very achievable and there's really a lot of opportunity there.
And Trimble's ag assets, what makes them, I guess, valuable to AGCO, or how do you think it's going to add to the portfolio?
Yeah, Trimble was one of the first really to enter I would say the precision ag space before a lot of the OEMs went more vertically integrated and started developing a lot of these technologies in-house. So there's an established track record there, and the products are well received in the marketplace, and they've got pretty good distribution. I'll maybe circle back to, they only paid 13.8 times EBITDA for this asset, which we think is very reasonable. If you remember, just 2 years ago, CNH bought Raven to really expand its precision ag portfolio, and they paid north of 35 times. So we think it's a pretty compelling deal, not only from a strategic perspective, but financially as well.
Very exciting stuff. Also last week, there were a lot of analyst days. Mustafa got to attend a few in the US. Let's start with Sensata. What were some of your big takeaways at that analyst day?
Sure. So for our audience and for those who don't know, Sensata is it was traditionally a sensor maker. So things like tire pressure monitoring sensors, and their primary end market is the automotive end market. 5.5 billion market cap, 4 billion in annual sales. So solid mid-cap company with very good operating margins of around 20%. And their investor day last week, we thought that the main takeaways were that they try to convey the message that they are on track to hit their big goal in their switch to electrification. Um, they did a lot of acquisitions and a lot of organic investment to position themselves as a supplier of electric vehicles, and not just within the vehicle itself, but also within the charging infrastructure. So they're doing a lot more in high voltage electrical protection now compared to their history. Um, the issue they have is they're still subject to the volatility in the auto market, right? So they are still very exposed to the production numbers of the automakers. So overcoming that will be a challenge. The other issue is that this 2 billion revenue figure by 2026, initially it was set up as a 1 billion from automotive, 1 billion from other end markets target. But because the interest rates have shot up, they've decided to delever and reduce their M&A activity. So they're not going to go out and buy more companies that do electrical protection in the infrastructure side. So that shortfall has to come from somewhere, and it will be the auto market. So now they're saying that maybe around $1.2 billion will come um, from automotive electrification and 800 million from things like renewable power, infrastructure, and industrial end markets. Um, so there's a bit of an uncertainty there. But what gave us confidence there was that they said 90% of that 2 billion target is already in their order book. They're just waiting for the automakers and the other clients to ramp up their production of their EVs. Um, Again, short term, a lot of challenges. You have the UAW strike, you have launch delays, you have recalls as automakers are still trying to figure out how to efficiently produce an electric vehicle. Um, so there are some short-term challenges, and they also announced a small restructuring plan to sort of alleviate those concerns. Um, and with regards specifically to the strikes, they said they will lose maybe $7 to $8 million of revenue per week. Um, we'll see how long that lasts. So hopefully, if there's a resolution soon with the auto workers and the automakers, that challenge goes away. The other thing was their margin target. They used to have an aspiration of 21% operating margin. They raised that slightly. They gave a band, 21 to 23%. That looks very achievable to us as long as the auto volumes grow a little bit between now and 2023.
See, the best part about analyst days is to see the products, right? Any good showcases that you got to explore?
So there were two main things that they showed. One was a high voltage distribution unit. Looks like a fancy copper box. Um, but the main thing there is it has 8 times the power density of their previous models. It's more compact, it's lighter, so that allows automakers to have more space for batteries, right? Which is the main thing now, so that you get a longer range, a more powerful battery in your car. Um, and that is not on sale yet, but they, talked about how technologically advanced that is compared to other conventional distribution units. And the other thing they showed was a heavy truck charging system that goes into the truck. Chris may know better, but I think that end market isn't expected to ramp up EV production until at least 2026. So it sort of fell out of their financial framework for this investor day. But they did mention that the opportunity there is much larger than diesel trucks. Um, by the nature of the product, this is a capital asset, right? So you have more than one battery for redundancy purposes, and you're also working with much higher voltages. So a lot more components go into them compared to a light vehicle. And I think they said that the content value per heavy truck could be 10 times more compared to a diesel truck. So a very large opportunity there, but it's further out.
Great. And then you also went to FlowServe, right? Going to the flow equipment space. I know there's been a big interest in ESG. So if you can give a little insight into what they shared at their analyst day.
Sure. So FlowServe, a traditional pump and valve maker, they try to make their story a lot more about ESG this time around. The last one was in 2018. I don't think ESG was really mentioned that much, but given where we are in the with investor sentiment, ESG was the big thing this time. And they have announced a year or two ago a new strategy called 3D, diversification, decarbonization, and digitization. And that strategy has brought some bookings. I think 2022 bookings, 28% were attributed to these 3D segments. But the issue they have is they still have 40% of their orders from oil and gas, which can be very cyclical, right? They did set very modest growth targets, and their margin target is actually lower than what they said in the 2018 Investor Day. But it's just that the ESG story doesn't seem to be resonating with investors yet. If you look at their multiples, forward PE 19 times, Xylem, a flow control peer, which mainly addresses utilities water problems, that's trading at 25 times, right? So they're still trading at a discount to sort of ESG leaders in the flow space.
There's some room to improve.
Yeah.
Very good. Well, all this talk about ESG, decarbonization, a lot of that is also impacting federal regulation here in the US. And there are two sectors within our space that are really getting impacted by that. Karen, if you wanted to jump in here, I know the rental equipment companies and the HVAC industry have been benefiting from federal spending and on their concerns about ESG. What are your thoughts there?
I cover the rental industry and I also cover the HVAC sector, and both I think are huge beneficiaries of the legislation. The rental equipment industry benefits from broadly from all the major legislation, including the IRA, infrastructure, some focused educational related legislation. And they provide obviously the equipment for all these projects. Together, it's over almost $2 trillion in funds. Of course, a small portion of that goes to the equipment side, but it is material to the sector. The other important point is in these large projects, the big firms tend to do better. So we expect the large public rental companies to outperform the rest of the sector. People are concerned about some of the soft spots in non-residential construction. We think the flow of funds in all of these big projects is going to more than overwhelm some soft pockets, particularly in commercial construction. So that's a sector, and the programs are run from 5 to 10 years, depending on. It's shorter for the infrastructure bill, it's longer for the IRA bill. So there's a lot of money flow coming for a long period of time, just ramping up. The other part is the HVAC sector. That's been growing faster than the overall industrial sector for quite some time because of the increasing interest in climate. With the Inflation Reduction Act, that accelerates the interest in that and in climate change. And HVAC is a huge factor in buildings, in global in greenhouse emissions for buildings. HVAC generates about 40% of the greenhouse gas emissions in a building. Addressing the HVAC sector will have a material factor in cleaning things up. The money is largely in tax credits and also in spending. It covers a broad part of the sector: the consumer, the construction contractor, the companies that are building the building. So this has broad impact. And I think the HVAC guys are going to see the sector grow above that long-term 5% growth rate for quite some time. A lot of these benefits run through 2032. So we're talking about a very long tail in, huge amount of funds. So we're just starting to see that infrastructure ramped up to some degree this year, and we'll build from there. But IRA is really just getting started. So I think 24 will be where we'll see a bigger jump, and then it'll go up from there. So those are two areas. And on the HVAC sector, there is some concerns about residential. Again, I think these larger numbers are going to offset a softer North American residential market.
And with that tax credit, you can get that every year for 10 years, right? Like it's not just a one-time credit that you get.
Yeah, it's annually, and it can go. There's different parameters, but it can go up to $14,000 annually. So it's a meaningful number for the average consumer.
For sure. Another sector actually that I'll be joining the Equipment Expo in a couple weeks, and another sector that is impacted by electrification and these legislation funding bills is the outdoor equipment, like lawnmowers and gas blowers. So actually, California is one of the first starting next year to ban any emission producing equipment that is manufactured there for the sale. So that industry is going through electrification, just like the EV market, and an interest in ESG is also driving that there as well. So there's a lot of actually, Mustafa, there is a new rule, right, about the grid and capacity. If you want to go back to electricals, what is that going to have an impact on for the equipment makers there?
Sure. Actually, before I get into that, I think speaking of legislation, Karen, I think I heard from Sensata last week that refrigerant cooling leak regulation, is that coming around 2025? I think it started in California already, but is that something that your HVAC companies are watching?
Well, there is refrigeration changes that are going to be coming, and they've been underway for a while. But that is certainly going to be another reason to upgrade equipment. The old refrigerant is going to be very hard to get and very expensive. So that's a technological change, which we have periodically in this sector. And that's just another reason why people are going to have to upgrade equipment.
Mm-hmm, mm-hmm. Yeah, Sensata was talking about sensors that detect leaks and inform the owners. So within my space, electrical equipment, we have published a note on queues in the grid, the queue to join or connect to the US power grids. And the issue was at the end of 2022, there were 10,000 outstanding projects waiting for assessment. So before you build a wind farm or solar farm, you have to go to your local independent system operator who assesses how much power you will add to the local grid and whether that requires an upgrade to the transformers or overhead cables in the area. And in the US, the burden of the upgrades falls to the developers of these solar and wind projects. And yeah, at the end of 2022, as I said, we were at 10,000 projects in the queue, which is a very high number. There were wait times stretching over 4 years. And two things happened since the spring. The first is that one of the main bottlenecks was electrical equipment supply or the supply chain. And two companies in the space, Eaton and Hubble, they announced major investments to expand capacity. Especially Eaton stands out. They announced an extra $500 million of capacity investment, and that includes transformers, which is a key component which has been in short supply for nearly 2 years now. And then 2 weeks after that announcement, they made another announcement saying they're doing an incremental $150 million on top of that. So that was a big one. And the other thing is Hubble. They are also ramping up their transmission capacity investments in the second half of this year. They also used to give out their backlog, like a representative chart of their utility segment backlog. They stopped doing that, and we think that the backlog has probably peaked now, so it will start to come down as lead times improve. Um, so those are good news for projects that want to connect to the grid, but it's also good news for Eaton and Hubble and their competitors because they're going to now get the orders and the sales that were delayed because a lot of these projects were waiting to join the grid. The second thing that happened in the summer is that the federal government has recognized that these queues are an issue for the US to generate more renewable power. And they acted via the Department of Energy, and the Federal Energy Regulatory Commission adopted new rules for projects that are waiting in the queue. They're imposing firm deadlines for interconnection studies on the ISOs. They're forcing them to do cluster studies so that they group applications together and consider them together. They need to use new modeling standards. All of this basically aims to ease the queues and streamline the application process for people who want to build, solar farms, wind farms, whatever. And taken together, we think that that should drive the sales and orders of Eaton and Hubble, maybe not higher, but they could keep them at elevated levels, right? Because we're bumping up against very, very tough comps now. So maybe a high single-digit sales growth well into next year is not, it's not a huge stretch for these companies, and partially thanks to the help that's coming from the federal government on this.
That's great. So then with added capacity, there'll be a faster, hopefully, transition to renewables, I guess is the goal.
That's the goal, right? So very long wait times, very high cost to upgrade transformers and so on. And the other thing is we're in a higher interest rate environment, right? So a lot of these projects became economically unviable. So cancellation rates actually increased. People just decided not to build that next solar farm, right? But hopefully these are steps that will help ease the application process and the cost.
Right. You mentioned backlogs, and I want to go back to Chris. You reminded me that, a lot of the machinery companies in general have been dealing with an inventory situation. Maybe you can couple that in with your view for next year, but where are we? We're, in 4Q now. What's going on with their inventories and what might the future look like?
Yeah, so I would say, inventories continue to rise throughout 2023. And I think the restock story has largely played out. And I think there's going to be a heightened focus over the balance of this year, particularly as we exit 4Q as to where inventories sit, which will set up production levels for next year. As we think about the broader machinery markets, we think we're, at or near peak in most of the verticals. At large ag, we think we are at peak. Commercial vehicles, similar story. 2023 will be a very strong year. We expect 24 volumes to be down, probably in the neighborhood of 10 to 20%. Construction equipment, if you look at backlogs, we're again at or near record levels, but probably close to a peak there as well. But to Karen's point, we have, an immense amount of fiscal stimulus coming through and a lot of these mega trends that, probably provide a little bit more favorable backdrop into 24 and 25 for the construction machinery sector relative to some of the other machinery verticals where we see more pressure. Commercial vehicles obviously probably down the most in terms of volumes next year, and then probably large ag we're looking at mid-single digit declines, and then probably modest growth on the construction side. So we'll watch inventories closely over the balance of the year. The one area where inventories are definitely high are on small ag, but we know that we think inventories there have probably peaked. But large ag continues to rise. Construction equipment continues to rise. Excavators are one area we hear of some destocking in the back half. And then, commercial vehicles, while rising, are, still at a pretty healthy level. So not overly concerned, but we'll watch closely as the year unfolds.
Great. Yeah. I think inventories across the board. Is there anyone else wants to chime in about their own coverage with their inventory issues? I know consumer sectors or companies exposed to the consumer sectors like Stanley Black and Decker and Toro are definitely fighting through an inventory destocking, and it'll probably extend into next year as well.
Okay, supply chain issues have been a bigger factor in my sector, although that's really cleared up. I haven't really heard much about excess inventory. The supply chain remains the toughest still in aerospace. There's still problems getting build rates up because the availability of parts and labor have been an issue. That's really where we're seeing some of the inefficiencies. But as far as working capital and inventory build, it's not really discussed as an issue in my coverage.
For the electrical side, I guess industrial automation companies, specifically more discrete and distributor exposed ones like Rockwell, Cognex, they are seeing a major customer destocking, right? So that is affecting the orders of Rockwell negatively. They don't exactly disclose how much. And then Cognex sales are already down, partly because of big traditional discrete end markets like automotive, consumer electronics. They're in a bit of a down cycle, partly because their growth driver was the logistics end market, which built excess capacity during and after COVID. That's normalizing. So there's an element of destocking that the automation companies are seeing. I know Emerson, which Karen covers, is not seeing that, but that's due to their sort of late cycle energy exposure, which is a higher share of their sales. But there's an element of that in my coverage. And then Acuity reported recently, and they are also citing sort of customers buying less or demanding less lighting equipment. They also went through this cycle of customers stocking up and then destocking, and now they're saying that things are back to normal, sort of 20 to 60 days between orders and shipment. And basically, it's slightly weaker macro outlook, probably stemming from commercial real estate. But they are driving down their own inventory and driving positive cash flow. So maybe customer destocking, which has sort of happened, and now they're destocking to sort of generate good margins and at the same time good cash flow as well, even though the sales are down.
Well, one last pulse check I wanted to get from all of you is, China is celebrating their autumn festival this week, and I've seen across some headlines that there's a lot of travel going on. China's recovery has been on and off the past couple of years with the pandemic. I guess, what are your companies experiencing? Where do you see, the recovery or not? Any kind of insights there would be great.
With the exception of 3M, China is not a significant factor for most of my companies. And for the rentals, it's not a factor at all because they're all North America. The recovery in China has been slower than expected. It is going directionally in the right way, but I'd say generally that's been sort of in the negative column, but immaterial for most of the companies. It's less than 5% for most of the large caps that I cover. So a smaller issue than some of the things that are going on in consumer domestic markets.
So yeah, and I'd echo Karen's commentary. For most of the machinery guys, we're talking low single digits at most. I'd highlight two with probably the biggest exposure would be Caterpillar and Cummins. Historically, China's represented between 5 to 10% of consolidated sales at Caterpillar. This year, it will be below 5%. That market is kind of taking a leg down with each passing quarter here, but probably kind of approaching a bottom. I think the question now becomes, what does a recovery look like? Does the government get behind some kind of stimulus that turns China into more of a tailwind in 2024, or do we kind of muddle along the bottom here? But just not really hearing any green shoots or signs of a tangible recovery beginning to materialize yet.
So for me, I have some companies with major exposure to China, Amphenol 25%, Sensata, which I've talked about before, 20%. And there is a trend, or the common thread between these companies is that they do have automotive exposure within China, where there's a shift by the consumer from international car brands to more local Chinese car brands. And it depends on the company. For example, for Sensata, they do have much lower content in a Chinese brand compared to a US or European car brand. So that does affect them negatively. And that may not be a short-term thing unless they can find a way of increasing their presence in local companies. For the other companies, Amphenol and TE Connectivity, Amphenol, as I mentioned, 25% of sales exposure, but they're a lot more diverse in terms of end markets. So they're not affected as much, I would say. It's not critical to their equity story. And then the rest of my coverage is a bit more similar to Karen and Chris's in the sense that maybe the maximum exposure is around 10, 15%. It's not going to drive the story again.
Great. Thanks for the pulse check on there. I think that's all we have for today. It's been a great conversation about M&A, the machinery outlook, some of the great analyst days and stuff that attended, and then the fiscal stimulus that's helping the rental equipment and HVAC. So thank you all for your time and have a great day.